Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host Neena Mishra. My guest today is Jay Jacobs, Head of US Equity ETFs at BlackRock. And we are talking about thematic ETF investing in 2026. Jay, welcome back. Great to have you with us today.
Thanks for having me.
So any conversation about themes or thematic investing has to start with artificial intelligence because AI has been the dominant force driving markets for almost 3 years now, right? And lately, the narrative seems to be shifting towards this AI scare trade. But I wanted to start on a positive note, investing in the next growth phase of AI. And in your recent note, you wrote that, quote, "We have yet to scratch the surface on much of AI's potential, especially at the intersection of compute and conflict." Tell us more.
Absolutely. So, yes, we are effectively more than 3 years into this AI revolution, if you will. It's been over 3 years since ChatGPT was released to the public in November 2022. And what we're seeing is that, the initial stages of this AI revolution, there's a lot of enthusiasm, really clustered around the Magnificent Seven stocks and some of the really just kind of large cap tech names that everyone knows. But as the theme evolves, it's getting much more nuanced in terms of where there might be opportunities and risks in the market. We've really advocated for a long time that you have to look across the entire value chain of artificial intelligence, everything from digital infrastructure to power to semiconductors to large language models, applications, products, et cetera, to really see the whole opportunity set of artificial intelligence and to get more granular in terms of finding the best opportunities within that value chain. What we wrote about in our thematic outlook for artificial intelligence is really that we're starting to see an acceleration in adoption. This is what people have been waiting for. When companies are spending hundreds of billions of dollars on capital expenditures, you want to be able to see that money is being well spent and that there's strong adoption of all of that AI compute that's being put onto the market. And that's exactly what we're seeing. We're seeing that token usage is growing at a staggering rate, almost 20x over the last 12 months in terms of the amount of compute that's being consumed in artificial intelligence. We're seeing the use cases of artificial intelligence are broadening. And of course, we're starting to see more individuals, more companies, more governments, et cetera, all incorporating artificial intelligence into their everyday processes. So this has certainly been a shifting moment for artificial intelligence in the markets. But we remain with very high conviction that this theme is going to continue to grow over the long term.
Now, going back to the fair trade theme, so investors are clearly worried on two fronts. First, they now believe that AI is going to disrupt many existing business models. And then these companies that you mentioned, that these are pouring hundreds of billions of dollars into AI build-outs. So investors are concerned that these investments may not see adequate returns anytime soon. So from your perspective, do you think these concerns are justified, or is the market overestimating these risks at this stage?
Well, what we're starting to see in the markets this year is really an interest in the second order effects of the artificial intelligence revolution. So as I was mentioning before, a lot of the focus early on in this trade was really around some of those Mag 7 mega cap tech stocks. Now we're starting to see the market digest, one, what are some of the companies that had been left out in those earlier trades that might be really benefiting from artificial intelligence. In fact, we've seen a tremendous amount of interest in the power infrastructure space as investors look at who's really going to be supplying all of the power to these data centers. But at the other end of the spectrum, not just the opportunities, but looking at the risks, there's been a lot of questions around the software space as a component of the broader markets that might be disrupted by artificial intelligence. What we're seeing is that right now, the market is really pricing that in quite broadly, impacting virtually all software as a service stocks right now, rather than being more discerning on which ones might be more affected than others. But this is fairly typical as you see a theme mature. It typically moves beyond the flagship names and starts looking at the second order impacts of who's going to be impacted. So I think right now the market is still just trying to kind of digest this information around artificial intelligence and try to understand how it might impact different industries like software. I think it's probably painting with a little bit too broad of a brushstroke. Some companies will be negatively impacted because maybe their software is more replicable using artificial intelligence, but other software companies might actually benefit that they could produce more software, more product updates using the same amount of engineers as before, harnessing artificial intelligence in their own processes. So we're right now seeing it being painted with a little bit too much of a broad brushstroke. I think this is in particular where active management can be really helpful to help discern which parts of the market and which individual companies might be best positioned versus others.
I wanted to talk about Bitcoin and cryptocurrencies, other cryptocurrencies as well. Bitcoin is down about 50% from its record high, which was about $127,000 last October. And lately, it seems to be searching for direction at these current levels. And obviously, this kind of move has been quite unsettling for crypto investors. And your ETF, IBIT ETF in particular, which was the fastest growing ETF in history, that has lost some assets this year, along with other crypto ETFs as well. But it doesn't look like that crypto investors are rushing for the exits. So I'm curious how you are interpreting this volatility in cryptocurrencies, and also what are the key takeaways from the ETF flow data that you have observed?
I think you make a really important point. Yes, we've seen volatility in Bitcoin, which is to be expected in Bitcoin. We understand it's a volatile asset and it's going to behave differently from stocks and bonds. But by and large, we've seen fairly moderate outflows from the fund, all things considered. And I think that speaks to a few things. One is many people are still starting their educational journey on Bitcoin, or maybe they started it just in the last couple of years when IBIT and Bitcoin ETPs came to the market. So for many people, they're newer to the space. They're learning about the volatility. They're learning about how this asset can behave differently from stocks and bonds. And so this might be somewhat the first cycle they're going through. The second piece is within the different ways to access Bitcoin, we're seeing a lot of switching behavior. So you could access Bitcoin through futures. You could access Bitcoin through some individual stocks that tend to track the price of Bitcoin. Of course, you could buy it directly, or you could buy IBIT to get Bitcoin exposure through an ETP. And what we've seen through this latest bout of volatility is, in fact, many people are switching from their existing exposure to IBIT. IBIT is one of the most liquid ways to play Bitcoin. It's the largest fund. There's a very deep options market around it. And so that has helped from an asset perspective in terms of many investors really using this volatility and this latest sell-off to get into the structure that they really prefer to maintain Bitcoin exposure. The third thing is, we've always talked about Bitcoin in the context of a broader portfolio. Yes, it's a volatile asset. Yes, it's a unique asset, but it's really important not to just think about it as the standalone, but how does it behave in the context of a broader diversified portfolio. So we've put out different educational pieces around this. We've talked about how Bitcoin should really be looked at as 1% to 2% of a portfolio, which can really help in terms of managing the risk as well as taking advantage of Bitcoin's unique characteristics. And so for investors that have embraced that portfolio approach, yes, the volatility, yes, some of the sell-off might not be as desirable as they would like, but they've been planning for that type of volatility and drawdown risk by appropriately sizing Bitcoin in their broader portfolio.
Makes a lot of sense. Are there any other non-AI theme that you are bullish on? Because as we know, many investors are looking to diversify away from AI now because they have a lot of exposure to AI and AI related themes.
Well, I'll answer that in two ways because one is we polled advisors across the country earlier this year to understand what theme they were most interested in for 2026. And the number one answer was diversifying within the AI theme. So this goes back to the idea that, yes, a lot of people have exposure to the Mag 7 stocks already through, broad market indexes or otherwise. People still have a lot of conviction in AI. They're just looking for other ways to play it. And that's why we've seen, for example, a lot of interest this year in our power infrastructure fund, POWR. It's a way to get exposure to the AI theme, but not really owning tech names, much more in the utilities and energy space. But if we look really beyond AI, one of the other areas that's getting a lot of attention is really our megaforce of geopolitical fragmentation. This is the idea that we're starting to see really the rewiring of supply chains, a lot of investment in infrastructure within different countries, certainly in the United States, as we see efforts to reshore and to build stronger infrastructure at home. And then, of course, you've seen really changing practices in defense spending, where you see defense budgets growing around the world, particularly in areas like Europe and the Middle East. And you also see a changing definition of what makes a defense stock. It's not just about aerospace and defense anymore. You can be looking at tech stocks that are involved in defense. You could look at critical metals and materials. You could be looking at infrastructure names that are important for securing supply chains. And so if we really kind of take this broader geopolitical fragmentation theme, there's a component of manufacturing, there's a component of infrastructure, and there's a component of defense, all that come together as we think about what the future might look like from a geopolitical perspective.
Yeah, those are some very interesting themes. We've seen that there are so many thematic options available to investors. So what do you suggest to investors? How can they choose? How can they make decisions which kind of themes to invest in?
Well, there's certainly a fair amount of thematic strategies out there, but last year was a record year for thematic inflows. So what we are seeing broadly is that thematic investing is becoming a more and more important part of portfolio construction. If you go back, a couple of decades or so, you had the introduction of sectors, you had the introduction of styles or the style box. And those have long been important ways for how people think about constructing a portfolio and managing risks and opportunities. But when you look at 2025 and 2026, so much of the market is being dictated not by a sector, not by broad tech stocks, not by broad energy stocks, for example, or financial stocks. It's really looking specifically at themes like artificial intelligence, like geopolitical fragmentation, like digital assets that are having a really big impact on markets. So the growth of thematic that we saw last year, I think, is really emblematic of the growing use case for themes in portfolios as a way to, frankly, just construct modern portfolios in the 21st century. But beyond that, when investors are really looking at how to allocate to a theme, I think there's either two ways to do it. One is you can select the individual themes yourself. You can say, this is where I have conviction. For example, I have conviction in artificial intelligence. I believe that over the long term, this is going to be a strong play in the market. And then it's really up to the investor to understand what is the best tool to implement that. You could absolutely look at an index-based approach like ARTY that's going to get broad exposure to the entire value chain. Or increasingly, you can look at an actively managed approach like a fund like BAI, where there's a manager that's not only looking across the value chain at the best opportunities, but also looking at individual companies that could outperform. The second way, though, is to say, I don't know if I can pick these themes. I don't know if I have the right, way of evaluating conviction, or I find it difficult to pick the right fund to implement this type of exposure. And you can use a fund that's really just a thematic easy button, like Throw, which is a systematic strategy from BlackRock, which is actively rotating across themes in a very tactical way. So it's identifying themes for investors, it's timing the entry and exit points, and it's implementing those exposures by selecting the stocks that best represent those themes. So two very different approaches. Kind of, you could think about it as the a la carte menu of picking your own themes and ETFs to implement it, or you could get the price fixed meal of Throw that really takes the decision making out of it, but gives investors exposure to themes across the United States.
That's helpful. And I wanted to talk a little bit more about the role these thematic ETFs play in a portfolio. Are they better suited as short-term tactical allocations? But we know that timing the market is almost impossible, or they are more suitable as long-term holdings in a portfolio.
I think for the majority of investors, it makes more sense to think about these as long-term exposures. Timing the market can be challenging. These themes can often be more concentrated baskets because they're really, thematic ETF is trying to hone in on the companies that are best positioned to benefit from the rise of a theme. So they can be concentrated. Concentration means there can be more volatility. Volatility can sometimes bring out worse investor habits if people are trying to market time rather than stick to a plan for the long term. So, some investors might try to be more tactical with it. We think it's best for investors to really take a long-term view, not be too concerned about near-term volatility, but instead really think about how would it benefit my portfolio to get exposure to a long-term structural theme? And then importantly, where do I fund this from? For example, if you're looking at artificial intelligence, a really clear way to fund that in your portfolio is to sell a tech sector ETF. Tech sector ETFs are going to have kind of broad US tech exposure. It's going to include some names that might benefit from AI, but then a lot of names in that tech sector ETF might be some of those SaaS companies that have just sold off a lot because they're at risk of being disrupted by artificial intelligence. So if you were to sell down a tech sector exposure and allocate to an AI ETF like BAI, you can keep largely your country exposure the same because the US is the predominant leader in artificial intelligence. You can keep your sector exposure largely the same. Most AI companies are coming from the tech sector. There's a little bit outside of tech, but a lot of them are tech names. And instead, you can get much more granular within that sector to really harness the names that are going to benefit from AI rather than just having kind of the broad brushstroke of the tech sector. So I think when you think about it in that context of where am I funding it from and how am I thinking about what risks or opportunities I'm bringing into my portfolio with this exposure, it's much easier to take that long-term view when you allocate to a thematic ETF.
Excellent stuff, Jay. We'll have to leave it there, but thank you so much for joining us today and for sharing your insights.
Absolutely. Thank you for having me.
That was Jay Jacobs of BlackRock. Let's quickly recap the ETF tickers that we discussed. So if you're looking to get exposure to the entire AI value chain, consider the iShares Future AI and Tech ETF. The ticker symbol is ARTY. And in full disclosure, I own this ETF in the ETF investor portfolio that I manage. If you're looking for an active approach, you could consider their AI Innovation and Tech Active ETF. The ticker symbol is BAI. He also talked about investing in the power infrastructure, and the ETF there is the iShares US Power Infrastructure ETF. The ticker symbol is POWR, Power. We discussed Defense ETF. The ticker symbol is ITA. And of course, we also discussed the Bitcoin ETF, the iShares Bitcoin Trust ETF. Ticker symbol is IBIT. And also a programming note, the show will be on hiatus for a couple of weeks as I'll be traveling, but we'll be back soon with more interesting guests and more interesting topics, and we'll see you then. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.